Imagine two people. One is a genius, educated at prestigious universities, works at a top investment firm, earns a six-figure salary. The other never finished college, works as a janitor and gas station attendant for 40 years, drives an old car, lives in the same modest house his entire life. By any measure, the first person should be wealthier, but he's not. When the janitor died at age 92, he left $8 million to his local hospital and library. The educated professional, he went bankrupt, his reputation destroyed, his life in ruins. The difference wasn't intelligence. It wasn't education. It wasn't even investment returns. It was psychology. And today, we're breaking down the complete framework from Morgan Housel's Psychology of Money, a book that proves your relationship with money matters far more than how much money you make. Before we dive deep, if you're serious about building wealth, changing your financial habits, and understanding the hidden psychology behind money decisions, hit subscribe to Millionaire Playbook. We don't do surface-level content here. We go deep. We go practical, we change lives. Now, let's begin. The first and most important lesson from this book is deceptively simple. No one is crazy. Think about that for a moment. You've probably judged someone's financial decision and thought, that's insane. Why would anyone do that? But here's what Housel discovered through decades of studying money and markets. People aren't crazy. They're shaped. Everyone you know, including you, has a unique financial story shaped by when and where you were born, what your parents earned, what economic conditions you experienced as a child, and what's happened to you since. Consider this example from the book. Someone who grew up during the Great Depression learned that the stock market is dangerous. They lived through massive losses, unemployment, and poverty, so they avoid stocks entirely their whole life. That's not crazy. That's rational based on their experience. But someone born in 1970 who watched the stock market grow tenfold during their teenage years thinks stocks are wealth-generating machines. Same market, completely different conclusion. Both people are intelligent, both are reasonable, but their experiences created different money beliefs. This is called the end of history illusion. We think we know how the world works based on what we've personally seen, but our personal experience is maybe 0.00001% of all human experience, yet we build our entire financial worldview on it. The practical application? Stop judging other people's money decisions. More importantly, become aware of your own biases. Ask yourself, what did I see growing up? What did my parents believe about money? What economic experiences shaped me? Your answers to those questions might be the biggest driver of your financial future, not your income, not your intelligence, but your beliefs. Now, we move to one of the most dangerous concepts in finance, the inability to separate luck from skill. Housel tells the story of Bill Gates. Everyone knows Gates is a genius who built Microsoft, but here's what most people miss. Gates went to Lakeside School in Seattle, one of only 300 high schools in the entire world at the time that had access to a computer in 1968. Starting with 300 million high school students globally, only 300 attended Lakeside. That's 1 in a million odds. If Lakeside didn't have that computer, Gates himself said there would be no Microsoft. The computer wasn't available at most universities in 1968. Gates had access to something that gave him an unfair advantage at age 13. Is Gates smart? Absolutely. Is he hardworking? Without question. But is he a billionaire only because of his intelligence and work ethic? No. Luck played an enormous role. Here's the critical insight. Luck and risk are siblings. They're two sides of the same coin. For every Bill Gates who gets the lucky computer at 13, there's a Kent Evans, Gates' best friend at Lakeside, who dies in a mountaineering accident before graduating high school. Same school, same opportunity, different outcome. Risk. The problem is we ignore luck when judging success and ignore risk when judging failure, but the reality is far messier. Both luck and risk are constantly at work, and they're nearly impossible to measure. Think about Vanderbilt, the railroad baron. He violated laws constantly to build his empire. Was he a genius? Or did he just get lucky that authorities didn't shut him down? We'll never know. If he'd been prosecuted, we'd call him reckless, but because he succeeded, we call him visionary. This creates a dangerous problem. We try to learn from success stories and failure stories, but we can't actually tell which outcomes were earned and which were lucky. How this applies to your life practically. Stop looking for role models based on extreme outcomes. Instead, look for patterns. Don't study Bill Gates exclusively. Study the broad pattern of wealthy people and what they do. Don't study one bankruptcy and assume you know what causes bankruptcy. Look at the common threads. When evaluating your own life, give yourself credit for your effort and your decisions, but also acknowledge luck. When you fail, take responsibility for your decisions, but also recognize that sometimes risk just hits you. This balanced perspective prevents both arrogance and unnecessary shame. Now, here's a story that will change how you think about wealth forever. At a billionaire's party, author Joseph Heller was told that the hedge fund manager hosting had made more money in a single day than Heller had earned from his best-selling novel, Catch-22, over its entire history. Heller's response? Yes, but I have something he will never have. Enough. That word, enough, might be the most important word in personal finance, and almost no one understands it. Rasha Gupta was one of the most successful businessmen alive. He was CEO of McKinsey, worked with Bill Gates on philanthropy, sat on Goldman Sachs' board. His net worth was $100 million. By any reasonable definition, he had more than enough. But he wanted to be a billionaire. He wanted to be in the billionaire circle. So he committed insider trading, went to prison, and destroyed his reputation. He had $8 million coming in annually just from passive returns. Let me repeat that. $8 million a year doing nothing, and he risked everything for more. The psychological mechanism here is called moving goalposts. You earn $10,000, you think you'll be happy with $20,000. You get $20,000, now you think you need $50,000. You get $50,000, now you need $100,000. The goalpost never stops moving because satisfaction isn't tied to numbers, it's tied to relative position. This is why billionaires can feel poor. It's why six-figure earners stress about money. It's not about the absolute amount, it's about the gap between what you have and what you think you should have. Housel identifies the hardest financial skill, getting the goalpost to stop moving. How do you do this? Intentionally, consciously. You have to decide at some point, this is enough. This is my number. Beyond this, additional money doesn't improve my life. For some people, that number is $30,000 a year. For others, it's $300,000. The amount doesn't matter. What matters is deciding and sticking to it. The practical framework. Write down specifically what would constitute enough for you. Not a vague idea, a specific number. Enough for what? Enough to cover basic expenses? Enough to cover expenses plus meaningful experiences? Enough to retire? Enough to retire comfortably. Once you have that number, you can relax. Every dollar beyond that becomes truly optional. This psychological shift is worth more than any investment return. Warren Buffett is the wealthiest investor in history. Most people think this is because he's the best investor. Wrong. Buffett is the wealthiest investor because he's been investing consistently since he was 10 years old. $84 billion. Of that, $84.2 billion came after his 50th birthday. $81.5 billion came after he qualified for Social Security in his mid-60s. He's phenomenal at investing, but the real key to his wealth is time. He's had 75 years of compounding. That's it. That's the magic. Consider this thought experiment. Suppose Buffett was average, earning only 12% annual returns instead of his actual 22%, and suppose he retired at 60 instead of continuing to 89. How much would he be worth? $11.9 million, not $84 billion. That's 99.9% less wealth. Now, consider Jim Simons, a hedge fund manager who has compounded money at 66% annually, 3 times better than Buffett. Simons is worth $21 billion. Buffett is worth more than 4 times that, even though Simons is a better investor by every metric. Why? Simons didn't find his investment stride until he was 50. He had 30 years of compounding. Buffett had 75. This is the hidden truth about wealth building. The best investors aren't the richest. The oldest investors are. Time is the most powerful force in investing. It's not flashy, it's not exciting, but it's true. The practical application is straightforward but requires discipline. Start investing now, even if it's small. Start at 25 instead of 35. That 10-year difference will result in dramatically more wealth by retirement. The second application, don't interrupt compounding. Don't sell in panic during crashes. Don't day trade. Don't constantly shift your strategy. Let it work. That boring 15-year-old investment is more powerful than the hot new strategy you discovered last week. Section 5. Survival and Staying Wealthy, 1530 to 1845. Getting wealthy is one skill. Staying wealthy is completely different. Jesse Livermore was the greatest stock trader of his era. In 1929, when the market crashed and everyone else was losing everything, Livermore made the equivalent of $3 billion in a single day. He was one of the richest men alive. 4 years later, he was broke, completely broke, and eventually he took his own life. Rick Guerin was equally skilled as an investor as Warren Buffett and Charlie Munger. They started together, invested together. Then, in 1973, the stock market crashed. Guerin had used leverage, borrowed money to invest. When the market fell 70%, he got margin calls and had to sell his Berkshire stock to Buffett at under $40 a share. He got wiped out during the one moment opportunity was cheapest. Buffett and Munger survived. They had no leverage. They could wait. They could actually buy when prices were destroyed. Guerin couldn't. The difference between the three? It wasn't intelligence. Guerin was as smart as Buffett and Munger. The difference was survival mentality. Getting wealthy requires risk, optimism, and putting yourself out there. Staying wealthy requires the opposite, humility, fear that what you've made can be taken away, frugality, and acceptance that some of your success was luck. Michael Moritz runs Sequoia Capital, one of the most successful venture firms ever. When asked why Sequoia has remained successful for 4 decades while other firms flame out, he said, "We're always afraid of going out of business. Only the paranoid survive." That's the key insight. You need to be optimistic about the long term, confident the economy will grow, confident you can build wealth, but you need to be paranoid about the short term, preparing for disasters, building cash reserves, avoiding leverage that could destroy you. The practical framework has 3 parts. First, more than big returns, prioritize financial indestructibility. Can you survive a 30% stock market decline, a job loss, a major medical expense? If the answer is no, your priority isn't growth, it's security. Second, always plan for your plan to fail. What if markets return 4% instead of 8%? What if you lose your job? What if you need money earlier than expected? Build room for error into every financial projection. Third, develop a barbelled personality, optimistic about the long-term future, paranoid about what prevents you from getting there. Section 6. Tails drive everything, 1845 to 2115. Here's a concept that will fundamentally change how you think about investing and business. Most things don't matter. A tiny fraction of things matter enormously. Art dealer Heinz Berggren became extraordinarily wealthy buying art, but here's the secret. 99% of the art he bought was worth little, but that 1%, paintings by Picasso, by Matisse, by Braque, made him a billionaire. He could be wrong 99% of the time and still become wealthy because the 1% he was right about was that valuable. This is called tail-driven returns. In venture capital, it's obvious. Most startups fail. A few do well. 2% become massive winners. Those 2% drive 100% of returns. But here's what shocks people. This is also true of the stock market. 40% of all stocks in the Russell 3000 index lost 70% of their value and never recovered. But the index still went up 73 times over 40 years. Why? Because 7% of stocks, just 7%, performed so well they more than offset all the failures. Amazon drove 6% of the S&P 500's return in 2018 alone, and Amazon's success came from Prime and AWS, tail events within the company. The Fire Phone, the bookstore experiment, dozens of other Amazon projects failed, but the two that succeeded were valuable enough to create the entire return. This matters for how you evaluate your own investments and career. You don't need to be right about everything. You need to be right about a few critical things. If you hold 10 stocks and 9 of them go to zero, but one becomes a 10-bagger, you're rich. In your career, you don't need every project to succeed, but if one project becomes your breakthrough, everything changes. This also means you should expect failure. A lot of it, not as something to avoid, but as the natural cost of trying to hit something big. Section 7. Freedom is the highest dividend, 2115 to 2345. What is wealth really for? Psychologist Angus Campbell studied this question for decades. He looked at income, home size, education, location, all the external measures of success. What actually correlated with happiness? One thing: having control over your time. The ability to wake up and do what you want, when you want, with who you want, for as long as you want, that's the highest dividend money pays. A small emergency fund means you can take a sick day without financial panic. A larger fund means you can wait for a good job instead of taking the first one. 6 months of expenses means you don't fear your boss. A year of expenses means you can negotiate better terms. 2 years means you can take a job you actually care about, even if it pays less. This is why the author spent years being intentional about his lifestyle. He and his wife established a comfortable but modest lifestyle in their 20s. Then, every raise, every bonus went to savings. Now they live considerably below their means while earning significantly above it. This wasn't about being cheap. It was about buying freedom, the freedom to do work they find meaningful, the freedom to change careers if they want, the freedom to not be controlled by their job. Compare this to someone who matches their lifestyle to their income. Every raise gets spent. They feel no wealthier because they've simply upgraded their baseline, and they're trapped. They can't leave their job because they need that income. The practical application: your real goal isn't a fancy house or a luxury car. Your real goal is probably freedom, so structure your finances towards freedom, not status. Section 8. Reasonable versus rational. Here's a trap that smart people fall into constantly: confusing rational with reasonable. Rational means mathematically optimal. Reasonable means emotionally sustainable. Legendary investor Harry Markowitz won the Nobel Prize for mathematical portfolio theory. When asked how he invested his own money, he described a 50-50 split between bonds and stocks. That's not what his theory recommended. His theory said the ratio should be different based on calculations, but Markowitz said he was trying to minimize future regret, not maximize returns. That's not rational, that's reasonable. Here's another example. The Yale researchers proved mathematically that young investors should use leverage, borrow $2 for every $1 they have, to buy stocks. The math works. Over 60 years, you'd be 90% wealthier. But if the market drops 50%, you'd lose everything. Could you actually stay the course after losing 100% of your money? Probably not. So even though it's rational, it's not reasonable. The practical insight: don't aim to be coldly rational with money. Aim to be reasonable in a way you can actually stick with. This matters because the best investment strategy is the one you can maintain for decades, and you can maintain a strategy if it lets you sleep at night. If pure index funds bore you and make you want to quit, maybe owning individual stocks is reasonable for you, even if it's less optimal mathematically. The extra 2% returns from your discipline matter more than the 1% higher theoretical returns you sacrificed. This is also why it's okay to have emotional money moves. Own your house without a mortgage, even though mathematically it's inefficient. Keep more cash than advisors recommend because it makes you feel secure. These reasonable decisions often outperform purely rational ones because they let you stick with your plan. Section 9. Room for Error, 2600 to 2830. The most underappreciated concept in finance is margin of safety. Benjamin Graham, the father of value investing, said the purpose of margin of safety is to make the forecast unnecessary. Think about that. You don't need to predict the future perfectly if you build enough room for error into your decisions. Card counters in blackjack illustrate this perfectly. A card counter might only have a 2% edge over the casino, but they need enough cash to weather normal bad luck. The rule is 100 basic units. If your unit is $100, you need $10,000 to avoid ruin if you hit a bad streak. Without room for error, a mathematically profitable strategy bankrupts you. With room for error, you survive long enough for the odds to work out. This applies to every financial decision. Forecasting your retirement needs? Don't assume 8% stock returns. Assume 6%. That room for error means you'll save more than necessary, but you'll actually retire comfortably instead of running out of money if markets disappoint. Planning your career? Don't assume you'll stay in the same job. Don't assume your skills won't become obsolete. Build flexibility into your career path. The practical framework? For every financial plan, ask, what if I'm wrong? What if my forecast is off by 50%? Can I still succeed? If the answer is no, your plan doesn't have enough room for error. Section 10. You'll change. Here's a truth that will save you from decades of regret. You will not be the same person in 20 years. Psychologists call this the end of history illusion. You know you've changed a lot in the past, but you underestimate how much you'll change in the future. The person who swears they'll work 80 hours a week until 60 might realize at 35 that seeing their kids matters more than money. The person who planned to live modestly for 50 years might realize at 40 that they want to experience life now. This matters because many people make extreme financial plans at 25 that they regret at 45. The solution isn't to avoid planning. Planning is essential, but it's to avoid extreme planning. Instead of committing to a life of near poverty to maximize savings, aim for moderate savings throughout your life. Instead of committing to a career you think you'll love forever, give yourself permission to change course without feeling like a failure. The practical insight? At every stage of life, aim for moderate annual savings, moderate free time, a reasonable commute, and meaningful time with family. This balance allows you to stick with your plan as you inevitably change. Section 11. Everything has a price. Nothing good is free. This includes investment returns. The S&P 500 returned 11% annually from 1950 to 2019. That's incredible, but the price you paid for that return was devastating volatility. Looking at the chart, the shaded areas showing when stocks were below their previous high occupy more than 50% of the time. You were constantly looking at losses, constantly questioning your decision, constantly fighting the urge to sell. That's the price of 11% returns. The fee, the cost of admission. Netflix stock returned 35,000% from 2002 to 2018, but it traded below its previous high 94% of the time. Most days, you were losing money. The key insight is volatility isn't a punishment for making a bad decision, it's a fee you pay for accessing higher returns. Once you reframe volatility as a fee rather than a fine, you can accept it. You don't mind paying fees for good products. You mind paying fines for doing something wrong. Section 13. The seduction of pessimism. Pessimism sounds smarter than optimism. Tell people everything will be great and they'll ignore you or call you naive. Tell people catastrophe is coming and they'll listen, share your content, and praise your insight. In 2008, one of the most prestigious financial newspapers published an article by a Russian professor predicting that the United States would break into 6 pieces by 2010, with California becoming a Chinese territory and Alaska reverting to Russia. This was treated seriously because pessimism has intellectual allure. But here's the reality. The stock market increased 17,000 times over the last century, yet the newsletter industry is populated by prophets of doom. Why does pessimism win? Several reasons. First, it's evolutionary. Our brains are wired to notice threats more than opportunities. A negative expectation protected our ancestors from danger. Second, progress is slow and invisible. Medical breakthroughs happen slowly, then save millions, so people don't notice them. But a plane crash happens suddenly and gets international coverage. Third, pessimists extrapolate present problems indefinitely without accounting for how markets adapt. In 2008, Lester Brown said the world would run out of oil by 2030 because China's demand was outpacing supply. He was right about the direction, but the high prices incentivized new drilling technologies. Production increased. The practical insight is be optimistic about the long term. The world gets better. Companies figure out solutions. Innovation happens. But don't ignore near-term risks. Section 14. Stories and complete narratives. From 2007 to 2009, nothing material changed. The number of factories was the same, the number of workers was the same, technology had improved, knowledge had increased, yet household wealth dropped $16 trillion. Why? The story changed. In 2007, we believed in the story of perpetual housing price growth and the genius of financial markets. In 2009, we stopped believing that story. That's all that changed. One story worked, another didn't, but the real economy's capacity hadn't changed. This reveals a fundamental truth. Stories drive economics more than facts do. We all tell ourselves stories to make sense of a world we don't fully understand. Your daughter thinks blankets keep you warm, and that explains her experience. You think the economy works a certain way, and that explains yours. Neither of you knows the full story, but you each have a complete narrative. The problem is we're all blind to what we don't know, and we fill in the gaps with stories. When investing, this matters because you might believe a story that makes you invest in something dangerous or avoid something safe. The better you understand how incomplete your knowledge is, the more humble you'll be in your convictions. Section 14. Tying it all together. Let's summarize the complete framework for managing your psychology of money. First, understand that your financial beliefs come from your unique history. They're not universal truths. This allows you to question them and update them. Second, respect luck and risk. You're not as good or as bad as your outcomes suggest. Third, define enough. Decide what wealth actually means to you specifically. Fourth, prioritize time over returns. A small return sustained for 70 years beats a large return for 10 years. Fifth, survive first. Don't take risks that could destroy you. Sixth, accept that a few things drive most results. You don't need to be right about everything. Seventh, buy freedom with your money, not status. Eighth, be reasonable, not just rational. Ninth, build room for error into every plan. 10th, accept that you'll change, plan accordingly. 11th, understand that returns always have a price. 12th, be long-term optimistic, but short-term paranoid. 13th, recognize that stories matter more than data. 14th, define the game you're playing and ignore people playing different games. Section 15, tying it all together. Let's summarize the complete framework for managing your psychology of money. First, understand that your financial beliefs come from your unique history. They're not universal truths. This allows you to question them and update them. Second, respect luck and risk. You're not as good or as bad as your outcomes suggest. Third, define enough. Decide what wealth actually means to you specifically. Fourth, prioritize time over returns. A small return sustained for 70 years beats a large return for 10 years. Fifth, survive first. Don't take risks that could destroy you. Sixth, accept that a few things drive most results. You don't need to be right about everything. Seventh, buy freedom with your money, not status. Eighth, be reasonable, not just rational. Ninth, build room for error into every plan. 10th, accept that you'll change, plan accordingly. 11th, understand that returns always have a price. 12th, be long-term optimistic, but short-term paranoid. 13th, recognize that stories matter more than data. 14th, define the game you're playing and ignore people playing different games. Section 15, tying it all together. Let's summarize the complete framework for managing your psychology of money. First, understand that your financial beliefs come from your unique history. They're not universal truths. This allows you to question them and update them. Second, respect luck and risk. You're not as good or as bad as your outcomes suggest. Third, define enough. Decide what wealth actually means to you specifically. Fourth, prioritize time over returns. A small return sustained for 70 years beats a large return for 10 years. Fifth, survive first. Don't take risks that could destroy you. Sixth, accept that a few things drive most results. You don't need to be right about everything. Seventh, buy freedom with your money, not status. Eighth, be reasonable, not just rational. Ninth, build room for error into every plan. 10th, accept that you'll change, plan accordingly. 11th, understand that returns always have a price. 12th, be long-term optimistic but short-term paranoid. 13th, recognize that stories matter more than data. 14th, define the game you're playing and ignore people playing different games. Here's how to implement this starting today. First, write your money story. How did your parents view money? What economic events shaped you? What are your core money beliefs? This awareness alone will change your decisions. Second, identify your number. What is enough? Not a vague idea, a specific annual income or net worth that would make you feel financially secure. Third, start your independence fund. Every raise you get, don't spend it, direct it to savings. This builds your freedom faster than income growth. Fourth, pick a reasonable investment strategy. Index funds, individual stocks, real estate. The best strategy is one you'll actually stick with. Fifth, stop comparing your financial life to others. You're playing a different game. Define your game and stay in your lane. Sixth, every time you're about to make a money decision, ask yourself, is this buying freedom or buying status? If it's status, ask if it's worth it. The message of this entire book, distilled to one sentence: your relationship with money matters more than how much money you make. That relationship is determined by psychology, not mathematics, and psychology is something you can change. If you've watched this far, you're ready to change your financial life, not by earning more, but by thinking differently about what you already have. Subscribe to Millionaire Playbook for more deep dives into the psychology of wealth, because building wealth isn't about being the smartest person in the room, it's about being the most psychologically sound. Thanks for watching. Let's change your life.